Up on Business Incorporated. Zimbabwe's central bank lifts key interest rates to a record high of 80%. South Africa ends state of disaster after more than 2 years. Plus, Egyptian economy displays damage from inflationary pressures as business activity slump. Great to have you join us on Business Incorporated. I'm Ladi Williams. First off, let's take a look at what's happening in the markets. Starting with Africa, we see Nigeria's main index climbed by 0.14%, while South Africa's JSE index fell by more than 0.5%. Egypt's EGX 30 was down by 1.20% to 11,391 points. Meanwhile, Kenya closed positive on Monday. Over to the Middle East, where most of the markets we track were mostly in the green. The United Arab Emirates, the Abu Dhabi index, posted a 0.33% gain, while Dubai's main index was the lone decliner, retracted by 0.5%. Elsewhere in the region, the Qatari index went up by 0.78%, while Saudi Arabia's market was also in the green with a 0.40% advance. And now heading to Europe, amid the horrifying pictures from Bucha and other towns in Ukraine, EU leaders are debating how far additional sanctions against Russia will go, while Germany insists on keeping Russian gas flowing. Let's talk to Chris Koba right there in Berlin. Great to have you, Chris. Well, Germany has taken temporary control of one of the subsidiaries of Russia's Gazprom. Why is this?
Well, we are talking about Gazprom's German subsidiary, of which the country's energy regulator will become a trustee now until September the 30th. That is according to Germany's economy minister, Robert Habeck. The reason behind it is the growing distrust between Berlin and Moscow in the wake of Russia's war in Ukraine. Under German law, the government has the right to examine transactions involving non-EU firms deemed systematically relevant, Minister Habeck said, adding that Gazprom was operating critical infrastructure in Europe's biggest economy. Now, the move comes after state-owned Gazprom unexpectedly said it was withdrawing from its German subsidiary last week without disclosing any new ownership structure. The German unit holds several key energy assets, including a natural gas supplier, which has a market share of around 20% in the country. Now, according to the minister, the German government decided to step in because of the current unclear legal structure behind Gazprom's German subsidiary and the mother firm's failure to comply with the obligation to inform authorities of ownership changes. Under the interim arrangement, voting rights in the unit will be transferred to Germany's energy regulator, which also will be allowed to dismiss management members and appoint new ones. The leadership will also take all necessary measures to guarantee supplies, the economy minister said.
Quite interesting, but the head of one of Germany's largest energy providers is waiting on the discussion over boycotting Russian energy deliveries. What has he been saying?
Well, the German consumers and companies needed to prepare for drastic electricity and gas price increases should the European Union decide to cut off Russian gas. The CEO of E.ON, which is a real heavyweight on the German energy market, said that prices were already rising rapidly even without such a move. Philipp Thon warned that the energy firm was already seeing wholesale retail prices 20 times higher and electricity prices 8 times higher this spring than a year ago. The situation is very tense even without a stop in deliveries, he said, adding that the end of Russian gas imports would have drastic consequences for the German economy. How much further prices would rise in the event of a ban on gas from Russia depended on the extent to which Germany increases its reserves. Currently, they stand at around 25 to 27% of capacity, with heating season coming to an end and the next one to begin in about 6 months from now. Germany gets around 50% of its gas supplies from Russia. The German government is so far rejecting an EU embargo on Russian gas imports in response to civilian deaths in Ukraine.
And European markets posted, slight gains yesterday. How are they faring today?
Well, after a hesitant start, German stocks are edging upwards about an hour into Tuesday's trading session. The DAX gaining around 0.5%. Germany's blue chips index able to stabilize somewhat after trading almost flat on Monday. Now, Germany's car makers have spooked investors with the news of much weaker business expectations. Manufacturers expect declining sales and rising production costs due to high energy prices. And indeed, oil prices extended gains on Tuesday on the prospect of further sanctions by the EU on Russia, among which could be a ban on imports of Russian crude. The possibility of an embargo had sent prices sharply higher on Monday, which curtailed some of the sharp losses seen Friday in reaction to a pledge by Washington and other major economies to unleash millions of barrels from their stockpiles to keep a lid on prices, which are fanning already high inflation. It also offset an expected hit to demand in China from lockdowns in parts of the country, including Shanghai, sparked by a wave of coronavirus outbreaks.
All right, thank you so much. That's Chris Kober right there in Berlin. Let's move on now. We see shares in Asia Pacific were mixed, while the Reserve Bank of Australia kept its cash rate target unchanged. In Japan, the Nikkei 225 climbed 0.19% to close at 27,787 points, while the Topix index shed 0.23% to 1,949 points. South Korea's Kospi ended its trading day fractionally higher at 2,759 points. Elsewhere, Australia's stocks rose as the S&P ASX 200 advanced 0.19% on the day to 7,527 points. In Southeast Asia, Singapore's Straits Times Index gained 0.39% as of local time. Markets in Hong Kong and mainland China were closed on Tuesday. That's for a holiday. MSCI's broadest index of Asia-Pacific shares outside Japan traded 0.37% higher. And over to the U.S., where stock futures slipped in early morning trading as traders continue to assess the bond market's warning signals and latest developments in the Ukraine-Russia war. Futures on the Dow Jones Industrial Average traded 60 points lower. S&P 500 futures and the Nasdaq 100 futures were down 0.2% each, while Treasury yields rose broadly Tuesday. But rates on shorter-term bonds continue to trade above their longer-dated counterparts. The 2-year yield was at 2.461%, while the 10-year yield traded at 2.45%. The 5-year yield climbed 2.6%, while the 30-year rate traded around 5.51%. And now let's take a look at what's happening in the oil markets. The oil futures extended gains today as the United States and Europe planned new sanctions to punish Moscow for alleged war crimes by Russian troops in Ukraine, adding to concerns about supply disruptions while Iran nuclear talks stalled. Brent crude futures rose $1.20 to $108.73 a barrel, while U.S. West Texas Intermediate crude futures were up $1.25 at $104, getting back above the $90 mark. Both contracts briefly jumped more than $2 a barrel in an early Asian trade after a Japanese industry minister said the International Energy Agency was still working out details for a planned second round of coordinated oil releases. Now over to the metals markets. We see gold eased today as the U.S. dollar held firm on rising prospects of more sanctions against Russia and possibly bigger interest rate hikes by the Federal Reserve to reining inflation. Spot gold was down 0.2% at $1,928 per ounce, while gold futures were down 0.1% to $1,931. U.S. two-year Treasury yields climbed to their highest level since early 2019, and 10-year yields ticked higher today on Monday. Actually, higher yields increased the opportunity cost of holding a non-paying bullion. Spot silver shed 0.2% to $24.45 per ounce. Platinum fell 0.5% to $981, and palladium rose 0.5% to $2,286. All right, now for commodities market update, we see as food prices soar, it seems there's nothing like a cheap pizza anymore. Now, a small pizza from a high street pizza place costs about 1,000 naira, which is 82% more than it did last year. That a medium-sized one costs between 3,400 and 3,600 naira, which is 33% more than it did in 2021. Well, to break this down, we have Olufunto Ajeni Fuja, analyst, financial directors company. Quite interesting. Great to have you.
Thank you. Thank you for having me.
Yeah, so we see it seems like nothing is, safe with rising prices. Now, we've seen the pizza principle has been broken now. At this point, we're seeing rising prices of pizza globally and locally. I guess nothing is safe with rising prices of commodities at this point.
Yes, that's right. So obviously pizza prices are going up globally and domestically. Globally you have, food inflation, and, food production was already high, due to COVID-19 and the impact on the global logistics market. So now we're seeing supply disruptions worsen. The Russian-Ukraine war has taken things to another level. So, for instance, let's break down a pizza. Flour goes into a pizza, cheese goes into a pizza. After the war, wheat reached a record high. So that means it's going to filter into flour-based products. And cheese, imported inflation, because cheese is mainly made from imported milk and salt. So obviously, you're going to see the prices go up. Even the meats that go on pizza, they're imported. So that's going to add to the cost. Vegetables go on pizza. Food insecurity is a major factor. Making the prices of vegetables, peppers and stuff rise. Fuel prices, bad roads. All these things are going to filter into the price of a pizza. That's why we're seeing, prices go up for a small pizza by like 200%. In Nigeria, domestically, we have the forex shortage. We have exchange rate problems. The naira is losing its value. Cheese producers have to go to the parallel market to, get their dollars, and it's going to.
And we're seeing diesel prices actually skyrocket at this time, and obviously bakers have been complaining, and obviously that would trickle down into other segments of that economy. And
that's right.
And I'm wondering if this continues, what do you think Nigerians would be doing at this point? Would they still be buying pizzas?
Okay, so now I'm going to talk about the fact that we're kind of seeing a demographic shift. So it's mostly the youth, especially those in elite and urban areas, that opt for eating pizza. Obviously, not everyone in Nigeria eats pizza, but I feel, there's been a demographic shift. Usually, traditionally, in a Nigerian home, you'd go to the market or go to the supermarket to buy your ingredients, cook your food at home, eat as a family. But now we're seeing, more young people prefer to, opt for takeout, order in or go out to eat. So, and I think that mainly started, or that was bolstered during the lockdown. Ordering food was kind of like a solace for people, like that was the main source of joy.
Right.
I'm tired of eating my own food, so I'm going to order things. So I feel like it is the trend that we're seeing with fast food is continuous. You know, there's a great demand for it. And, you know, that also is affecting the prices because, you know, the supply side of things is struggling, but demand is gaining momentum. So that's obviously going to mean higher food prices. And this is not just pizza, this is fast food in general. You know, the young people now, you know, social media even has an impact, you know, the bandwagon effect. My peers are eating pizza, eating hot dogs, are eating burgers, so I want to.
Exactly, nobody wants to be left out.
Yes, I'm going to save my coins. Whether I can afford it or not, I'm going to save my coins and I'm going to eat it. You know, people on TikTok are eating pizzas. I want to as well.
Right. All right, Funto, we'll continue the conversation right after the break because this is far-reaching, you know, with rising commodity prices. All right, we'll continue the conversation in just a moment. Do stay with us. This is Business Incorporated. All right, welcome back. We're still drilling down on the commodities market update, and we have Olufunto Ajenifuja still here. And we're talking fast food, you know, and, you know, these rising prices of commodities affecting every, you know, aspect of that market. But, you know, what are some of the factors causing, you know, this shift, you know, to fast food, you know, instead of just cooking at home and, you know, saving money?
Yeah, I kind of touched on that, you know. I think, you know, the bandwagon effect is very important. Like I said, you know, when they see, and I'm going to, you know, when, you know, youth in Nigeria, you know, they have access to their phones, you know, that's one of the things that social media has done so well, giving access to, like, you know, people globally. They see on TikTok, they see on Instagram that their peers over there are eating, you know, chicken burgers, beef burgers, pizza. So, you know, these global fast food brands have also set up shop in Nigeria. So why not just go out, you know, and see what my peers abroad are eating? And, you know, like I said, there's a change in taste, you know, especially those that have a higher income, because, you know, the demand for pizza is elastic because it's based on income, really, because it's a luxury, you know, it's still considered a luxury food item, you know, especially kids that have, you know, parents that, you know, earn a bit more. They'll be like, oh, Mom, I want pizza. I don't want swallow. I don't want eba. I don't want rice and stew. You know, I want pizza. I want burgers. I want popcorn. I want, so, yeah.
And obviously this will be far-reaching because we're also seeing high-end restaurants, you know, hike their menus because you go to a high-end restaurant and just for two people you're eating over 60,000 naira. It's actually going up. But now tell me, how do you see this? What's your outlook, you know, for this fast food condiment?
Okay, so that was actually a really important point. So this is what I think. I think the demand is going to shift to these fast food, you know, pizza places. You know, more shopping malls are opening by the day. And, you know, they have, you know, you can go to the movies, you can get popcorn, you can get hot dog. You know, you can, like, I feel like demand will shift to those things, you know, because they still have the same experience of being able to take their families out, but they're not spending, you know, 15K per person. They're not spending 20K per person, because I don't think the demand to go out to eat is going to go down. I don't think the demand for takeout or for those type of foods, for fast food, I don't think that's going to go down because, you know, people, you know, times are tough, you know, they still want to be able to enjoy their lives.
They want to enjoy the ambience.
Exactly, enjoyment still needs to happen. So I think demand will shift from those like higher price premium restaurants because, you know, they are also feeling the impact of supply chain disruptions, and, you know, these businesses have invested so much, you know, to create that luxury experience. So it's only right for them to increase their prices. So I think my outlook is that prices will remain elevated. I don't really think demand for these experiences is going to go down, but demand will probably shift more to the, you know, to the fast food restaurants. And yeah.
Right. Well, maybe I might have to grab a pizza after this at this point, because this has definitely raised my hunger for it. But, you know, there's also that issue, you know, with, you know, health implications, you know, when it comes to fast food. But we're still seeing, you know, people, you know, driving there, and, you know, obesity.
Yes.
That's one major, you know, aspect of eating out. But anyway, Funto, thank you so much. It was great having this conversation with you. Olufunto Ajenifuja, Analyst, Financial Derivatives Company. Thank you so much.
Thank you so much.
All right, now let's move on. We see Zimbabwe's central bank lifted its key interest rates to a record high to halt a decline in its currency, and reigning surging inflation amid food and fuel price pressures have been exacerbated by the war in Ukraine. Monetary Policy Committee hiked the rate to 80% from 60%. Well, joining us now is a professor of economics at the University of Zimbabwe. We have Gift Mogano right there. Great to have you, Gift. Professor Gift.
Thank you very much. Good afternoon.
Yeah, so we've seen the Zimbabwean dollar lose nearly 2/3 of its value against the greenback, and annual inflation quickened to about 72.7%. How much impact can we expect from this hike?
Definitely, we are going to expect, we expect inflation to go up because obviously from a cost push factor point of view, a lot of companies in Zimbabwe rely on loans from the banks. You are aware that with COVID-19 pandemic, most of the companies lost their cash flows. In fact, a study by World Bank shows that in 2020, companies lost sales on average of 58%. And by end of 2021, we were around 50% again loss of cash flows. So companies are relying on banks. They go and borrow money. So when you raise the rates to 80%, it means companies will pass this cost to consumers on the back of this policy measure.
All right, Professor, it seems we're having a kind of a challenge there with your audio, but if you can hear me now, I see economic agents, taking loans for speculative and, arbitrage purposes. What's the catch here?
Thank you very much. So that's not a correct position when you put it on a balanced scale. The central banks view, yes, that's what you are saying. They think that the economic agents are borrowing money from the banks and they buy foreign currency, but that's not the major driver of the exchange rate movements.
Yeah. Hello, Professor. Well, regrettably, the connection is not good enough. But Professor, we'll have you again to be able to finish your thoughts, at some point. That was Professor Gift Mogano, Professor of Economics, University of Zimbabwe, talking about the Zimbabwean monetary policy actually raising rates to the highest. They're the highest in the world now, is about 80%. We'll try and get his thoughts some other time. But moving on now, we see South Africa's President Cyril Ramaphosa declared an end to the state of disaster declared more than 2 years ago to manage the coronavirus pandemic. Transitional measures, including wearing of face masks at indoor public spaces and limits on gatherings, will remain in place until new regulations are promulgated next month. Ramaphosa said that this announcement enables all economic activity to continue as normal. Government introduced a series of strict lockdowns under the state of disaster, including restrictions on business activities, led to the biggest economic contraction in at least 73 years in 2020. Africa has had 3.7 million confirmed coronavirus cases so far, and more than 100,000 of those were diagnosed with the disease have actually died. All right, moving on to North Africa. Now, a measure of Egypt's non-oil economy dropped to the lowest in 21 months as inflationary pressures made worse by Russia's invasion of Ukraine, as well as a weaker currency, led to a sharp decrease in output and new orders. According to a survey of the purchasing managers by S&P Global, companies reduced job numbers for the 5th month in a row, and business confidence fell to a record in March as Egypt contends with the surging cost of energy, food, and raw materials. Egypt is a major food importer that buys most of its wheat from the two countries currently at war. That's Ukraine and Russia, really one of the Middle East's most indebted nations. Egypt has been hit hard by record grain prices, suffered a further disruption from the conflict because Russian visitors previously made up a significant portion of its tourism market. quite a far-reaching effect for Egypt there. All right, so that's it on Business Incorporated. Thank you so much for watching. Do remember, we'll have this again, same time tomorrow. I'm Ladi Williams. Thank you for watching. Bye-bye.